gold for the last 20 years has beaten the S&P on a total return, including dividends. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven. It's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's getting attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. The lie that's been told to many investors, too, is that gold is too volatile. So it's not a coincidence that we're in this moment in history. Gold is reaching all-time highs again, policies, and frankly, the sins of the power-hungry, short-sighted, myopic policymakers who only think one election cycle ahead rather than generations ahead, and have destroyed our currency in a slow frog boil.
Although gold once appeared riskier, its volatility has matched or even trailed that of the S&P 500 since 2000. Crucially, gold doesn't default or drop to zero, unlike individual stocks. Gold had superior returns in 23 out of 53 years, just shy of half the time. According to the data, its performance was powerful during periods of weak market performance, including the inflationary 1970s, the dot-com boom and bust, and the immediate aftermath of the Great Financial Crisis. Economic and financial expert Matthew Piepenburg mentions that his recent article, "Is Gold the Perfect Lie Detector?" was inspired by gold's sharp rise in 2025. He argues that gold isn't as volatile as critics claim, as it steadily outperforms traditional assets, including the S&P 500. According to Piepenburg, gold's rise reflects global distrust in fiat, not a newfound fanaticism for gold. Prompted by ECB warnings, Piepenburg notes gold's rising demand is exposing vulnerabilities in Europe's paper-based system. With $1 trillion in gold derivatives, mass redemptions could trigger serious financial stress. The ECB analysts expertly address the recent surge in gold prices. They link the rising cost of gold to the high levels of uncertainty perceived by investors. They also analyze the distribution of gold demand across derivatives, spot instruments, and, more recently, a marked increase in COMEX futures, and they emphasize gold's role as a safe haven asset. However, ECB analysts express concern that in times of crisis, the gold market could become a source of danger. Should extreme events materialize, there could be adverse effects on financial stability arising from gold markets. What the ECB analysts are truly afraid of is a mass awakening among market participants. That people realize the true nature of the fraud in the fiat money system, and that gold market turmoil could expose it. While reflecting on the market, Piepenburg highlights a long pattern of monetary deception from Nixon to post-COVID policies. He notes gold exposes truths that officials often try to conceal. Before we dive into Matthew Piepenburg's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets.
What prompted me to write this article today or that came out today, wrote recently, as Gold, the Perfect Lie Detector, basically, for financial markets, is the reason gold is rising exponentially. Again, I don't know how many all-time highs we've had just in this year alone. It's the highest performing asset across the board in 2025. It's outperformed the S&P for 20 years on a total return basis. U.S. Treasuries are the worst performing asset over the last 5 years. They're down 50%. So this is not a gold bug, gold chill, sell your book, gold apology moment in history. And more importantly, gold has been very, very consistent for decades, frankly, for millennia and throughout history. But as we hit this inflection point in 2025, there's so many strings we could pull on. But what prompted me to kind of just remind people of the dishonesty and how indestructibly honest, indestructible gold really is was some recent headlines, Elijah, that came out here in Europe, and they were on all the mainstream and yellow journalism. It was just everywhere in Switzerland and Germany and France, etc., that the ECB was making headlines because a group of economists at the ECB finally said the quiet part out loud, as I like to say. They couldn't, it's like a Freudian slip. They said gold could bring down the European system. Now, that's an extremely extravagant phrase. It made headlines, gold bringing down the EU, gold bringing down the economy. It wasn't that gold was doing anything than what it always does, which is hold its value, while paper money gets increasingly debased to monetize, frankly, criminally negligent monetary systems in the EU and the central bank at the ECB. And basically what this ECB economist report was is all the physical demand for gold is undermining the European system because there's been such a massive outflow, as you and I have been talking about over the years, certainly with COMEX, and Andy Schekman's been following this and I've been following this, and you understand that these flows from the London to the New York exchanges, way beyond just BRICS and de-dollarization, but this need for physical gold and not future contracts on the COMEX or the LBMA exchange. So in other words, countries want gold, but they're in all these derivative levered products, levered 100 to 1. And long story short, Europe doesn't have the gold or the money to meet its contracts. And they have over $1 trillion in derivative exposure to gold. Hence the headlines, could gold bring down the European system? It's extravagant. But what I'm basically saying is the European system, the central banks, the LBMA banks, the derivatives markets, all these weapons of mass destruction are finally being admitted to and confessed by even the economists at the ECB. And so basically what they're admitting to is it's a lie that paper contracts levered 100 to 1 do not equal an ounce of gold. In other words, they don't have the gold or the money, and they're caught in a major pickle because the counterparty to these European contracts is effectively Wall Street. And again, as things get more and more desperate, again, any string we pull, military issues, geopolitical issues, debt issues, bond issues, risk assets, stock issues, private equity. As things get more crazy, gold becomes more relevant as a conversation piece, as a store of value, and as a sane truth teller. And the truth is, once again, there was another open lie that derivatives and futures contracts and paper gold is not gold. And now there's $1 trillion uh-oh moment in Europe. Gold always kind of quietly bides its time and does its honest work. And I was thinking, in the course of my entire lifetime, which I was born in 1970, so we went off the gold standard in 1971. Nixon promised A, that was just a temporary measure, and B, that your dollar would be worth just as much tomorrow as it is today. So that was the first open lie. Obviously, decoupling from gold has not been temporary. The entirety of my life, we're still decoupled from gold. We don't have a chaperone to our fiat money. And the US dollar has lost 99% of its purchasing power and measured against a milligram of gold. So that was the first obvious lie. That just let's just call a duck a duck. And as I was saying that, it's worth noting that even the US Constitution, Article 1, Section 8, our founding fathers said, don't go into the trap of separating your currency from gold and silver, because if you do so, you'll be seduced by that siren of debt. You'll print more money, you'll create more money than you have gold, and you'll go into hyperinflation. That will slowly create social unrest and destroy your country. That was warned 250 years ago by our founding fathers. We violated that in 1913 when Wilson lied again and created the Federal Reserve Act, put the Federal Reserve into law. Then I was just thinking of more modern examples when I was once and became a professional on Wall Street. I remember certainly the great financial crisis of 2008, which is effectively a credit crisis from derivatives, unregulated derivatives and mortgage-backed securities levered to the moon. And when I was at Harvard, Larry Summers was the president, and then he became secretary of assistant secretary of Treasury. There was a famous thing that never made the headlines. When he was at the Treasury Department, he called up Brooks Lee Bourne, who was the head of the CFTC, which was the commodity office. And he wanted to just lever the heck out of derivatives. And she was saying, this is a very dangerous thing. I don't think you should do that. He publicly humiliated her in Congress and said, trust me, the bankers and the counterparties in these derivative markets know what they're doing and can manage the risk. Well, within 7 or 8 years of him saying that, we had the biggest derivatives explosion, the greatest financial crisis in years. And that was the great financial crisis of 2008. So the Harvard president, the Treasury official, and the great mind of Larry Summers was completely dishonest and wrong. And that was just a recent example. Again, gold sits back during this whole string side of dishonesty. I talked to investors from Dallas to Davos. It's amazing what the registered advisory industrial complex or the wealth managers at the big banks, whether it's Pictet or Goldman Sachs or Morgan Stanley or JP Morgan or Bank of America, where you have to have high minimums just to get their advice. They all said, recently, until gold made the headlines, is, well, I was always told that gold was too volatile all these years. And yet, again, that's just a lie. Either it's really ignorant or really dishonest. And again, I'm not making these numbers up. Gold for the last 20 years has beaten the S&P on a total return, including dividends. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven, it's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's getting attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. And so the lie that's been told to many investors, too, is that gold is too volatile. And yet now central banks around the world, including the ECB, are trying to get as much as they can. And my whole point was, when the liars have to tell the truth, and when the liars are actually stacking gold at record levels, that's when you know there really is an uh-oh moment. And certainly we understand gold. This is nothing new to us. We're not, even as Jeffrey Gundlach could confess, these gold guys aren't maniacs. They're not stackers. They're right. He just said it. So again, it's not about being a gold bug defendant or apologist or shill. These things are confirmed throughout history, certainly the last 2 decades. More importantly, the bond king himself, Jeremy Grantham, in the equities side.
In the interview, Matthew Piepenburg observes rising gold ETF inflows, but cautions they don't replace physical gold. He emphasizes gold is long-term protection, not a momentum trade. He criticizes institutions like Harvard for illiquid private credit exposure. Even seasoned investors are misallocating due to herd mentality. After a 5-month run of net inflows, global gold exchange-traded funds saw net withdrawals of $1.8 billion in May 2025, according to the most recent World Gold Council data. Despite May's loss, global gold ETF flows have remained positive so far in 2025 at $30 billion US. Holdings have also seen a cumulative rise of 322 trillions during the period. Increased U.S. Treasury yields have negatively impacted the demand for gold ETFs, but the recent trends are not necessarily bad news. For example, growing concerns about stagflation would push investors toward gold, which has historically done well in times of stagflation. Far from just a hedge, Piepenburg notes that gold is rising as a Tier 1 strategic reserve recognized by central banks and the BIS. This marks a global shift, especially among the BRICS, away from dollar dependence. He urges people to view gold as the quiet backbone of a new monetary system. Let's get back to the interview.
Always happy to talk to people over the years who can't make the minimums at Von Greyer's because we're a very high-end, high-net-worth client base. It just is how we operate out of Switzerland. That doesn't mean that Egon, myself, and my partners aren't very concerned about everyone else. We talk 99% of the time to people who won't be our clients so that they can, as Egon says, get a milligram here and there, or possibly an ounce over the years. I've bumped into a young man who came to visit me in Zurich, who's in his 30s, who works for himself, never went to college, and has been slowly stacking gold. And I'm encouraged to see even ETF inflows into gold now as it's making headlines. I hope people understand that ETF gold is not the same as physical gold. We've talked about that and written about that, but at least it's a sign that there's a move into gold. Many of that demand may come from people just chasing price, like whether it's gold or Nvidia or Bitcoin, they're agnostic. They're just seeing it up 25, 26%. Let's get in. And they're always coming in late on just the price momentum. As we've always said, gold is not a momentum trade. It is a new form of money. It is real money, and it is a long-term investment, and it is there to ensure against the dying purchasing power of your fiat dollar. Nevertheless, it is encouraging to see flows into gold ETFs, but we've always said physical gold is the only way to go. It is interesting that the common man, if he can, and I respect how difficult it is to get an ounce of gold if you're worried about rent, mortgages, car payments, insurance, etc., in a very recessionary backdrop, which is only going to get worse rather than better. Of course, it's hard. But as Egon and I've tried to say, get as much as you can, as realistically as you can, bit by bit, time by time. We've been saying this for years. Now with the price, as you said, near 3,500, there's a race to really do that. Harvard's endowment's over 50 billion, but they've had to issue bonds recently because they don't have liquidity, because most of their money is tied up into these credit pools, private credit pools, which are, again, Gundlach, who's the bond king, says those are the weapons of mass destruction. I just wrote an article about private equity, which is the belle of the ball, the prettiest girl to dance for many institutions and family offices. Private equity is turning as well because they're not marked to market. They're whatever the accountant at the private equity or private credit fund says they are. When there's volatility in the markets, those valuations tank, and the liquidity is not there as we head into the end of a credit cycle. So again, the smartest guys in the room too, we're chasing the trends, chasing the CIOs of those family offices or those endowment funds, which are just alumni from former banks who are just thinking the way they've been trained and thinking, frankly, in I would call a sustained level of mediocrity. Honestly, it's consensus think, it's safe, it keeps you hired at Harvard or at Goldman to be bullish and to sell diversification models that always work in a bull market when things are going well. And when things start to fall apart, then they come racing in trying to figure out a non-dollar asset, hard assets, including gold, including silver. But even the smartest guys in them are late to the party. And, family office is running around to unload their private credit investments at a discount because they misallocated, because they misunderstood wealth management, risk management in the form of that pet rock analog old gold asset that no one wants to talk about, but has been quietly telling the truth for centuries and frankly for decades, just in recent memory. I find that staggering. And I find it really funny and comical when people say you're just selling your book when gold has just been quietly outperforming everything else. It's not to say I told you so. It's not to be smug. It's just to tell the truth as we see it and as the facts show them and as the numbers tell us, and to get more people not to just become Von Greyer's clients. It's to get people to understand the risks they're facing. That gold for us, and certainly for Egon Von Greyer's, who did buy gold and lots of it at $300 many years ago, who has made a very modest fortune, who never brags about it, but has never wavered on the price of gold or the direction of gold, never once apologized for gold. He has high conviction, but he never bought gold just for the price appreciation. Of course, he's happy to see it go from 300 to 3,400, but that was never his goal. His goal was, I need to protect my Swiss franc, my euro, my dollar from itself. I'm going to save in gold and spend in fiat. That's exactly what our clients do. That's exactly what the central banks are now figuring out, late to the party. And that's exactly what the de-dollarization thing with the BRICS is all about. We no longer want to save in U.S. treasuries, U.S. dollars, or paper money. We need a real hard asset that holds its value, that is a store of value, that even the BIS has recognized as a tier one asset, the only other tier one asset besides the laughable 10-year. So these are not gold bug defenses. This is the flow of smart money late to the game. It's the flow of history at the end of a credit cycle. And it's the obvious choice. It's not even, as the ECB economist kind of hinted, gold isn't even an allocation. It's not even a speculation asset. It's not even a hedge. It is a part of the new system. It is a part of the new world reserve currency. It's because it's not the world reserve. It's not going to replace the dollar, but it is the new world reserve asset. It is a strategic reserve asset. It holds its value better than any sovereign bond, whether it's from Germany, China, Brazil, the BRICS, or including the United States. Again, not fable, but fact. The evidence is all around us. And I just wrote this article to remind people of these simple things. Get past politics, get past partisan thinking, get past bull or bear on the S&P, get past strong dollar, weak dollar, milkshake or no milkshake, get past Bitcoin versus gold, because it is the evident truth all around us, whether you're looking at bonds, currencies, central banks, the BIS or the IMF, they all, or the BRICS or the oil trade, everything is about gold at the center of the narrative and about inflation being inevitable, even if we have deflationary periods. It's just trying to shake you by the shoulders and have you look at this. Doesn't mean become a devotee of Von Greyer's gold or Matthew Piepenburg or Grant Williams or Ronnie Sturfula or anyone else or Andy Scheck or anyone else who understands sound money, or yourself. Do your own homework. Look at the facts. You can have different opinions. Even Gunlach, who says, look, if you guys are into Bitcoin and you like the leverage, you like the return, just buy gold and lever it then if you want. It's going to be more stable. So again, it's not even about these debates anymore. They're getting tiresome. They're important. We could keep having them. And I'm not even saying that gold goes in a straight line. It's just obviously rising because paper money is falling. And paper money is falling because, as history confirms, the debt is too astronomical in these trillions, these unfathomable numbers. And anyway, another long-winded answer, but I just can't understate it or overstate it, enough.
2025 is off to a shaky start, but gold is excelling. For investors looking to navigate today's complex economic landscape, adding gold with yield offers a unique combination of growth, stability, and income. Are you prepared for a world where gold regains its central role in global finance? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.